Defying the stereotypes, breaking the rules. You can't tell me what is for me. Yeah. You got a lot more behind those pretty eyes, but you gotta let the world see. Yeah. So shake it up. Now is the time while you waiting. You're good enough. Now is the time while you waiting. What are you waiting on? Don't let them bring you down. If they ain't rocking with you, so what? Yeah, you're gonna be cool without them. Don't let them bring you down. If they ain't rocking with you, so what? Yeah, you're gonna be cool without them. Oh, don't let them bring you down. Don't let them bring you down. Oh, don't let them bring you down. Don't let them bring you down. Don't believe all that you see in magazines, filtered images so blinding. Yeah. You weren't designed just to be somebody's dream. Find your voice and break the silence. Yeah. So shake it up. Now is the time while you're waiting. You're good enough. Now is the time while you're waiting. What are you waiting on? Don't let them bring you down. If they ain't rocking with you, so what? Yeah, you're gonna be cool without them. Don't let them bring you down. If they ain't rocking with you, so what? Yeah, you're gonna be cool without them.
Good morning and welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and today we're going to talk about direct indexing. Last week, we started the conversation of passive investing and active investing. Passive investing is synonymous with index investing. It's not really a buy and hold strategy because index, contrary to a lot of people's understandings, indexes are not stationary. It's a big misconception a lot of people have. Last week, we did a program where we talked about passive and active investing a great deal, and there was a lot of interest that was in that. So that prompted me to put together a program that was designed just around passive investing that is direct. And you're going to learn a lot more about that today, and you'll understand the concepts of it, the pros and the cons, and you'll get to ask questions as you go along too. And that reminds me, if you're joining me live today on Tuesday at 11 o'clock, you can be part of the program. Enter your questions into the platform, whichever one that you're listening to, whether it's YouTube or Facebook or Twitter or Periscope. You can enter your questions in and get them answered today. So before we begin into, I do want to remind you that there are important disclosures that we put at the very end of the video. So stick around and listen to those because those are significant. So let's get right into that concept of direct index investing. Oh, one more thing before I do that. Make sure that if you like the content, that you hit the like button or you hit the subscribe button. If you're over on YouTube, I have some new information coming up, a new segment that I'm going to be talking about at the very end of today. And you don't want to miss a very moment of that because that's going to be extremely helpful to you. I really do believe so. So let's get into the idea of direct index investing. What the heck is direct index investing? Let me bring it up on the screen here and let's start that conversation. Okay, direct index investing is a really, really simple concept. Direct index investing gives you the ultimate in control over top of your investments because what you're doing is you are actually buying every stock in the index, or you're buying a pretty good representation of the stocks that are in the index. There are some types of indexing that we utilize that they don't buy absolutely every stock that's in the index, and it could be like in the S&P 500, or it could be in the Russell 2000. Some people don't want to own all 2,000 stocks, although that you could for about it's about $16,000 around that range. You could actually own every single stock in the Russell 2000. And direct indexing has actually made that so much easier because of the pricing and the availability of the stocks that's there. But the control really comes from owning the individual stocks themselves. The idea is that you have a custodian, and the custodian could be somebody like Fidelity or Active Brokers, or I use a company called Folio. They are actually the custodians, and they hold the stocks. Now, a long, long time ago, I used to have a client that had a lot of Exxon stock, and he had worked there for 30 years. And for some reason, he actually wanted to have the stock certificates issued to him. And you can really do that. I don't advise it, because if you lose those certificates, you've actually lost the value, because they are negotiable documents. So most people will have them electronically banked, electronically held at a custodian, and it makes it so much easier to keep track of it nowadays, especially if you're doing direct index investing. Because if you own the NASDAQ 100, do you want to have 100 certificates that are negotiable around your house, or that you have to put in the bank? Or think about the Russell 2000. My goodness, if you own 2,000 stocks, you actually could get 2,000 stock certificates. Not something that you really want to do. The other aspect of control that's available for owning stocks directly is that you decide what happens. It gives a lot of confidence to people in owning individual stocks, because you own them, you control when they're bought, you control when they're sold. You don't have to worry about being in a mutual fund where a mutual fund manager is making the decisions for you, or actually in an index fund where the decisions are made randomly based on certain factors. And we're going to talk about that in just a few moments as we go along here. I want to just give you an idea about direct index investing, because let me back up for just a minute. I might throw out a lot of different terms that might seem foreign to some people. Some of you understand them fully. You might understand them better than I do. But the idea of direct index investing is investing in an index. What's an index? An index is a part of the economy. And there are stocks that are representative of that part of the economy. And that's how indexes are created. There's an index association. Actually, it is called the Index Industry Association. The Index Industry Association reports that there are about 3.3 million indexes throughout the world. Now, that's fascinating to me. The reason why that's fascinating to me is because in the United States, there's only 5,000 stocks or less. And that's actually less than there was in the 90s. From the 90s, it's gone down from around 7,000. I think it was about 7,193 was the last number I remember seeing from the 90s, when the dot-coms were very prevalent. It's gone down to around 5,000 publicly traded stocks. Now, you might be saying, well, what about penny stocks? Because I asked that question. I thought there must be thousands of penny stocks. There's not. To be classified as a penny stock, you are basically looking at a stock that's less than $5. It doesn't have to be less than $1. It can be less than $5. There are actually penny stocks on the major exchanges. Now, an exchange is where the stocks are traded. And that's what I wanted to talk to you about briefly, because I think if you understand how all this came about, it helps you to understand how your money is positioned currently and why it is in the situation that it is. So I'm going to take just about half a minute and explain to you a little bit of the history of how index investing came about. Let me make this just a little bit bigger for you to make it easier for you to see. Stock ownership used to be very difficult back during the 1900s. When it first came into prevalence, you had to have a lot of money to be able to own a stock. So if you were starting a public company, it took a whole lot of effort and a lot of money, and just think there weren't computers then, so everything was done on ledgers. So it was pretty difficult. By the time we got to the 1940s, it was a little bit different. Remember, in 1929, we went through the great market crash of 1929, and there were a lot of people that got taken advantage of with stocks. So the United States government came up with the Securities and Exchange Act of 1940, which gave a lot of guidance and regulation that went along with it. Now, I'm not going to go into all the details of it because there's pages and pages of it. But by the 1940s, stocks were formally starting to be gathered into groups, and those groups were called mutual funds. They were regulated, and they were called mutual funds. By the 1970s, this is the time actually when John Bogle first began Vanguard. It was a mutual fund that was made up just of the stocks in an index. And the S&P 500, which was was the largest 500 companies in the country, Bogle just thought, well, let's just buy those stocks and follow whatever goes on in the economy. That's what most people were buying. Lo and behold, that's actually turned out to be very prevalent, as we have seen with index investing. And as you might recall from a few moments ago, the idea of index investing has exploded because there are thousands and thousands of different indexes. There's really only 3 prevalent ones in the United States. There's the S&P 500, there's the Dow Jones Industrials, and then there's the NASDAQ, or the over-the-counter. I like the NASDAQ a lot, and actually I'm going to talk a little bit about that in the very beginning. But I don't want to get off track too much here today because we want to talk about direct indexing. Direct indexing then began from the idea of exchange-traded funds. You see, with a mutual fund, like even in index funds, they only trade once a day. When you send money in or you buy that particular index fund, when it settles or at the end of the trading day, that's when they come up with a price. If you buy an individual stock, those trade all day long, and you get the stock price at that point in time. And there's lots of information that you can get about when the best time to do that is, but that's digression we're not going to go into today. The ETFs are more like stocks. It's the idea of an index fund where that you own a particular segment of the economy, except it's traded like a stock during the day. And there's a lot of other benefits to it also, primarily that there's not as much expense that goes along with it. Well, in the 1990s, when the idea of putting together a group of stocks and calling it an ETF came about, it was more available to people that you didn't have to have a lot of money to go into it. So the idea became very popular. So there were people and are people that are around from that point in time in the 90s that thought, I really don't want to be in a particular group. I don't want to go by the guidelines that they have put out for the exchange traded funds. I just want to own the stocks of the index. That's about the time that really direct index investing became prominent in the 1990s. It's really changed a lot because of one thing, and that one thing is technology. Technology has changed it a great deal. There's really 2 different types of direct index investing. Let's make this a little bit smaller now. We don't need it quite as big. There's only really 2 types of direct indexing. There's the direct indexing that's available that is when you're just buying the stocks in itself. I help clients with a thing that's called the direct NASDAQ index, or they call it the Folio 100. It goes through the Custodian that I utilize. And it's going to be buying those 100 top stocks that are in the NASDAQ. There's no management that goes along with it that's saying you should buy this or you should sell this. It's just buying whatever is existing in the top 100. Now, it's not all the stocks of the NASDAQ because there's about 3,500. It's just the top stocks. And actually, if you stick around to the very end, I'm going to tell you a little bit about a new segment that I've created that's going to help you to understand a lot more about the NASDAQ. The other type of direct index that is available is one that uses factor investing. Now, factor investing, what's that? Factor investing takes a couple of different levels. There's one level where someone might say, I don't want to invest in companies that are involved in alcohol. There may be people that say that I don't want to invest in companies that are involved in animal testing. Those are different social factors that are utilized to eliminate companies in the index. And remarkably, you might see like the S&P 500, there are a lot of companies that are actually socially responsible. You may have heard of ESG, or environmental, social, and governance. That's become a very prevalent concept because people want to be socially responsible. Companies are trying to be more socially responsible. One issue with that is what you think is socially responsible and what I think is socially responsible may be different. So with direct indexing, you can say, I don't like what Twitter does. I don't want that in my index. Or I don't like what, name the company. We don't want to be selective and say just Twitter. Let's say, I don't like what Zoom does, although I do like Zoom a lot. I don't want Zoom in my index. For whatever reason, you pick it. That's the control that's given to you by having direct indexing. And there's a couple of other really big benefits out there too. Before I get off of factor investing, there's another level of factor investing that does involve an expense. That's where we actually buy research. Think about this. If you had the S&P 500, are all 500 of those companies going up? If you listen to some day traders, you would think, yes, they all go up. Stocks always go up. How many times have I heard that? No, they don't. If you get to the end of the year, you're going to see that even in the S&P 500, that there's going to be a number of companies that end the year negative. So the idea is going to be that what if you could just eliminate the companies that don't have regular profits? Or what if you could just include companies that pay dividends? That's a factor type investing. And when we get into that, there's research that goes along with it. It's generally charged to the client. It's in between, I'd say, 30 basis points to 100 basis points. That's 0.3% to 1%, but you get to choose. You don't have to have factor investing. You could actually have direct indexing, or the pure direct index investing, where you're actually just owning that index by itself. So let's go on and look at a little bit more about some of the ideas of direct index investing. Now, remember, this is where you own the stocks. You own directly the stocks. And I want to remind you that if you're listening to this live on Tuesday and you've got a question about direct index investing or retirement in general, put it into the comments and I'll take time and look at it. If we don't get time to look at all the comments today, I'll make sure to post a response on whatever platform that you're listening to. If you're listening to this as a replay later on during the week, then put your comments in too, because I monitor the different platforms and I will be glad to answer your questions as they come about through the week. But I want to get into some of the concepts that really set apart and what make direct index investing so unique and make it so interesting to so many people. Let's make this just a little bit larger on the screen so that you can see better what I'm talking about. I'm going to go through these real quick, then I'm going to pick them apart just a little bit. Direct index investing avoids reconstitution. It allows principal-based investing. We talked about that just a little bit. It also reduces concentration of stocks and it aids in tax management. Let's go through each one of these just a little bit so that you can get an idea of how it works. Now, reconstitution. This has nothing to do with constitution, but reconstitution, think about it. If you were reconstituting something, what would it do? You're basically mixing it back up again. And that's what reconstitution is with an index. If you own the S&P 500 or you own the Russell 2000, whatever index it is, that's not a stationary index. It's not stagnant. It changes based on a lot of factors. take a little bit of time if you're interested in this subject and go back and listen to the live stream that I had from last week on July the 21st, because you're going to find that there's a lot of information in there about passive investing, index investing that you had no clue about. But to make a long story short, and to sum up what we talked about last week, we talked about the Russell 2000 and how the Russell 2000 actually had hundreds and hundreds of changes for a lot of different reasons throughout the year. Why do exchanges have changes? Well, things go on during the year. Organizations change. They might go from a private company to a public company, or maybe in this particular instance, it would be reversed. They go from a public company to a private company. Or perhaps they have a merger, companies merge together. That can change it. It can make it into a larger company. Just ask yourself this question. There's been a lot of talk about Amazon being split up. If Amazon was split up, would it still be on the same exchange? Would it still be on the NASDAQ, or would maybe some of the parts go over to another type of exchange? See, you can be on any exchange that you want as a company. There's certain capital requirements to be in the Dow Jones Industrials and the NASDAQ, excuse me, not the NASDAQ, but the New York Stock Exchange. The NASDAQ is probably the easiest because they don't have the capital requirements that the New York Stock Exchange and the Dow Jones Industrials do. But the idea is that you avoid the changes that happen because of reconstitution of stocks if you own a direct index. And that can be a really big benefit to you. It also avoids the fact that if there's bankruptcies out there, think of it this way. We've seen several bankruptcies this year. That affects how indexes are organized in itself also. The other idea of principle-based investing is a big advantage too. We talked about that just a little bit when we were talking about it in the very beginning, but let me just recap that somewhat. If you own the S&P 500 and you said, I don't want to own companies that invest in animal testing, that's okay. You don't have to. You could pick those companies out, or you might look for biblically responsible investments. ESG is one of the things that's come about in the past years, and a lot of companies have embraced the concept of ESG, or environmental, social, and governance principles, because it's made their company more popular. A lot of times it's because people might think, well, they're just doing the right thing. Well, it's become that ESG, acting responsibly, has actually become good for business, because there's a lot of people out there, me included, that don't want to invest in companies that are doing terrible things to the environment. We talked about that a couple of weeks ago. So if you own a direct index, you can actually selectively pull out stocks that you don't like. You may be a Christian and you might not agree with some of the concepts that some companies operate by, and you can pull those particular stocks out if you want to. Direct index investing gives a lot of control to you. It also reduces the concentration of stocks. Let me make this just a little bit bigger so that you can get the idea here, because this is significant to a lot of people. Remember a little bit ago when I was talking about the client that worked for Exxon for 30 years and owned a lot of Exxon stock? Well, index investing along 30 years ago, he wasn't as, the idea of index investing wasn't as prevalent. But had he have wanted to buy into John Bogle's Vanguard investments when it first began, he may have thought, well, I really don't want to buy that because it's got a lot of Exxon stock in it. I already got Exxon stock, so why do I want more? If you own a direct index and you have a concentration of stocks someplace else, you can selectively pull that out, so it can help you to balance out your investing a little bit more. There's other circumstances where people might not want to own stocks for conflict of interest reasons. Let's say, for example, if you're an attorney and you're litigating a particular against a company and they're a publicly traded company, you probably don't want to own their stocks. I had that happen with a client of mine that had a 401k, and he came to me and said, I have a big case that's going against this publicly traded company. I don't want to be in a situation where I own the stocks of this company and it be pointed out, because it could be shown as a conflict of interest for one reason or another. So in that situation, direct indexing helps a whole lot, and attorneys that are litigating public companies really want to investigate the idea of direct index investing, because it gives you a lot of control over what companies that you actually hold. Now, another group of professionals that need to be careful of conflicts of interest are accountants or CPAs. If a accounting firm is doing an audit of a publicly traded company, it is a conflict of interest for them to own that company that they are auditing. Think about that for a minute. They're publicly reporting on profits and losses and everything else that goes along with a publicly traded company. And how would it look if they actually own part of that company? So you can see that direct indexing is a really big benefit to some particular professions, because they don't want to have the conflicts of interest that might exist. Now, tax management is the broadest attracting factor of direct index investing, and this is why. With tax management, there's a lot of reasons. Now, think about this just for a second too. Direct index investing can be used in accounts like IRAs, SEPs, simple plans. It can be used in those types of qualified plans, but it's not as significant because those taxes are already deferred. If you own stocks individually outside of a retirement plan, every time that activity goes on with a particular stock or any type of investment that's owned by you individually, there's some sort of tax implication. If there's a profit, it has to be declared. If there's a loss, it can be taken advantage of. So the idea of tax management, it really is amplified. The benefits are amplified by having a direct index. Now, one of the big ones that happens to people who own mutual funds is phantom capital gains. And this is actually going to happen to a lot of people this year. It might end up happening to you if you own a mutual fund. I have seen this happen dozens of times over the years. And this is what happens. When the stock market falls, a lot of times portfolio managers have to sell stocks that they have held on to for years, months, whatever the case is going to be. They have to sell it at a profit. They also have to declare or report the gains that were obtained by that stock, if there were gains that were obtained by it. Now, it may be a stock that portfolio held on to for a long time, and they're reporting it, and those gains are passed on to you as the investor. Now, here's where the problem comes in. Think about this. We're in the midst of a coronavirus pandemic. The market went down significantly in between February and March. There were a lot of mutual fund managers that had to sell a lot of stocks because there were a lot of people that said, I want to pull my money out of this particular mutual fund. To do that, they had to sell stocks that they have held for some time because the market had been going up. What happens to the person that just bought into that mutual fund in January, and then they look at it sometime during this year? If the value is down, they are still probably, I say probably because we don't know, everything's not over yet, they are still probably going to have a capital gain declared. Now that's crazy, because you could have invested money, your value could be less than it is now, and you're getting a 1099 that says, hey, you have a taxable gain. Yes, that does happen. But here's the good news. Direct index investing avoids that. Now, it doesn't happen as much in ETFs or index funds, but it still does happen. If you own an index directly, you avoid that circumstance completely. So another advantage from a tax standpoint is we talked about a little bit ago the reconstitution of stocks that are inside of indexes. Every time that happens, it can create a taxable event if something was sold. Let's say, for example, last week we talked about in 2017 with the Russell 2000, there were several stocks that grew significantly. So they were moved from the Russell 2000 up to the Russell 1000. Well, when those stocks were sold within the index, that created a capital gain. And some companies that were replicating the Russell 2000 may have had to pass on those capital gains to their shareholders. That doesn't happen in a direct index because you get to choose if the stock is sold or not. So you avoid the tax effects that goes on with reconstitution. The other concept of tax management with direct indexing is tax loss harvesting. Now, this is a biggie for a lot of people that own stocks directly or own investments outside of retirement plans. And this is the reason why. If we looked at all of the stocks of whatever index it's going to be, it doesn't matter whether it's the NASDAQ 100, the Russell 2000, the S&P 500. If we look at all the stocks of that index, whatever index it's going to be, it does not have every stock go up in a particular year. It would be a miracle if it did, but it generally doesn't happen. There's going to be some stocks that have losses. Now, the only way that you can take advantage of those losses is if you sell the stocks that's there. Now, if you had losses inside of a ETF or inside of an index fund, you'd have to sell the entire fund at a loss to be able to take advantage of a loss. Now, let me just kind of clarify that just for a minute, because for some of you, I may be talking about things you're saying, tax loss? What's he mean? Well, a tax loss is where that you have a loss in an investment. If you sell it and you stay out of that investment for 30 days, you don't create what the government calls a wash sale. You stay out of that investment for 30 days, you can actually take advantage of that loss. If you have other capital gains, you can match the capital losses to the capital gains and pay less income taxes. You can actually to a certain degree, you can take advantage of capital losses off of your general income taxes. Now, I don't do income taxes. That's something that you need to talk to your accountant about, but you can take advantage of losses from year to year with selling selective investments. No, I digress. So let's get into the meat of this. If we have a direct index, what happens is we sell the stocks that have losses. And by selling the stocks that have losses, we have losses to carry forward on our tax return. So we pay less taxes. Now, there are some money managers out there in past years. I won't mention them right here. They're actually listed on my blog, but they've said that you could make as much as a 5 or 6% increase in return because of tax loss harvesting. Well, that's overstating it a lot. And actually, the SEC came in and slapped their hands and said, hey, guys, you're making a false statement. You can't increase rates of return by that much. And I agree with that. On the other hand, there's other firms that have stated that, it's more reasonable. We're looking at maybe a 0.77% increase on average for our customers by doing tax loss harvesting. What I tell people is it depends upon your particular tax situation. Everybody's is a little bit different. If I am doing direct indexing for a client, I'm hoping to be able to give them as much as 1% to 2% gain in what they have over top of their regular returns. Now, that doesn't happen every year and it's not guaranteed. Remember also to listen to the disclosures at the very end or read them, because it'll tell you that that's not guaranteed. But the idea is if you could increase your gains, your taxable gains by even 0.5%, wouldn't it be worth it over a period of years? And I think that if you're investing in indexes, you're going to be nodding your head and going, yes, it would be worth it. So The idea of tax loss harvesting is a significant advantage of direct index investing. Now, direct index investing is really pretty simple. And really, if you wanted to go out and you wanted to go to whatever company and you wanted to say, I want to buy all the Russell 2000, or I want to buy the S&P 500, or I want to buy the NASDAQ 100, you could do that and you could buy it on your own. If you look for help through an advisor like me, we do charge a fee for helping people along. And mine's pretty simple. The fees basically that I charge to clients is going to be between 1% and 0.4%. 1% for smaller accounts, 0.4% for larger accounts. If you want to see the breakdown, go to my website at richardsfinancialplanning.com. All the way down to the bottom, there's a lot of different things on the bottom, and look for the word fees. If you click on that, it'll give you more specifics of how the fees work. Now, another fee that is involved sometimes in direct index investing is going to be the factor fee, the research fee. If you utilize that, then that particular company may have an independent cost. There again, I've seen factor research be in between 0.3% and 1%. It all depends upon what you as a client want. And you may look at it and go, I don't want to have factor investing that costs something. I just want to buy the direct index, and they're happy to pay me my fee to help them out. Also, the idea is that if you pick the right custodian, you don't pay any trading fees too. And that's real important. The other important factor of picking a custodian is make sure that there's one that uses fractional investing. Now, what do I mean by that? Fidelity is calling it slice investing. Whatever you call it, it's buying a portion of the stock. If you wanted to go out and buy Tesla, you'd have to pay over $1,000 a share. If you want to go out and buy Amazon, it's around $3,000 a share. You can't get a lot of diversification with a small amount of money by buying the whole shares. So if you buy fractional shares, you can buy portions, and a good custodian will charge you no fees to do trading, and they'll offer fractional investing. That makes it much more affordable and makes it much easier for you to work with them and for me to work with you. So how does all this work? There's really 3 steps to it. And let me tell you what those are real quick before we end today. The very first thing that you need to do if you're interested in using direct indexing is talk to me. We discuss your vision and what your individual needs are. And then the second step is we create a custom index based on your needs. If you want to use factor investing that involves principal-based investing or something else, then we incorporate that into whatever that you're utilizing or whatever your goals are. And then basically you set up the account and you monitor it. It's so simple. You own it. So it's very simple to work with. All right. So let's get to the very last thing that we're going to talk about today. Well, not the very last thing, almost the very last thing that we're going to talk about. If you've heard some things today that sound interesting to you and you want to talk about them, you can get a time to talk to me individually. Go over to my website at richardsfinancialplanning.com. Look for the blue button that you see right here on the screen, and it says schedule a call to learn more. If you want to learn about whatever I'm talking about on the website, that's cool. Just click on there, find a time. We spend 20 minutes and talk, and you can discuss over the phone what you have in mind or ask your particular questions about your circumstance. If you want to talk about direct index investing, we can do that too. But you can do all that over at Richards Financial Planning and find a particular time, and we'll talk a little bit. The last thing I want to tell you about, I am really excited about doing this. Factor investing has become such an interest that what I'm going to do is help educate people on the stocks that are out there that are available. Now, in general, you might have heard me mention earlier, there's only about 5,000 stocks that exist in the United States. And I'm going to focus on 100 of them in the NASDAQ 100. And on a daily basis, what I'm going to do on market days is give you an update on the NASDAQ 100 on what's going on, and I'm going to pick in between 2 and 4 stocks and dive into them just a little bit more, talk about what's going on with that particular stock, talk about what it does. There's a lot of stocks out there that you probably have no idea what they do. You might just say, yeah, I want to buy an index fund, but do you know what the companies do? The idea is I want to help educate you on what some of these companies do and how they work, and that'll help you be a better investor and make better decisions. And when you make better decisions with your money, you're more confident about everything that you are doing with your money, and you're able to do what my purpose is, and my purpose is to help you retire at one point in your life and live the rest of your life and not worry about running out of money. That's the whole idea. If you listen to some things today that you thought were interesting and you'd like to hear more, of course, call me up or send a time, but also tune in on a regular basis. Subscribe. If you're on YouTube, go over there and hit the subscribe button so that you can hear about it more. If you're on Facebook, hit the thumbs up. If you're on Twitter, hit the heart, so that you can get this in your stream on a regular basis. And let me get this out of here. Okay. That's it for today. This has been a great show. I didn't have any comments that came in that were relevant to what we were talking about. So if you do have a question that comes about this week, if you're listening to this on a replay, go ahead and enter it into the comment, whether you're subscribed or not. I'd love for you to subscribe, but if you're not, that's okay. Go ahead and hit the subscribe button so you can learn more about it. But if you want to ask a question, put it into the flat platform, and then I'll take the time during the week and get back to you. The other thing is, starting today, tune in at 4 o'clock Central Time, and we have 4 particular stocks that we're going to talk about in the NASDAQ 100. We'll recap a little bit of what's happened throughout the day and help get you educated so that you can be on the road to learning how to retire and not worry about running out of money. Thanks a lot for taking some time to listen to me today. And coming up next is the disclosures at the very end. So thanks a lot and have a great day.